Welcome to This Explainer. Today, we're going to completely demystify stock evaluation and prove once and for all that you really don't need a PhD to make way smarter decisions in the market. We are diving deep into the art of the stock, breaking down the numbers, the narratives, and showing you how blending those two worlds is the ultimate secret to building a truly bulletproof portfolio.
Picture this. It's January 2000. Merrill Lynch analyst Henry Blodgett famously argued that traditional valuation just wasn't a helpful tool for a hyper-growth company called Internet Capital Group. It's a fascinating and honestly kind of terrifying cautionary tale from the dot-com era. Because look, there have always been investors who believe market prices are driven purely by hype, perceptions, and the excitement of buyers, rather than anything as boring as, actual cash flows. But the brutal reality of relying purely on that exact mindset, what we like to call the bigger fool theory, is that eventually the market runs out of fools. The whole theory assumes you can just pawn off an overvalued stock to someone else for an even higher price. And while perceptions absolutely do matter, they literally cannot be the only thing that matters. Just 1 year after that glowing analyst report, Internet Capital Group's stock absolutely tanked, plummeting from $174 down to a dismal $3 a share.
So, how do we make sure that never happens to you? Well, here is our 5-step game plan. We're going to tackle the illusion of precision, pit numbers against narratives, decode the annual report, evaluate the environment using Porter's 5 forces, and finally wrap it all up with the hybrid investing approach.
All right, let's kick things off with step 1, the illusion of precision, where we're going to debunk some major valuation myths. When you see those massive, sprawling spreadsheets, it is so easy to feel intimidated and assume financial modeling is this exact, flawless science. But we really have to ask ourselves a fundamental question before we put our hard-earned money on the line. Is valuation actually an objective search for a definitive, true value? Are we discovering an absolute mathematical truth here? Well, spoiler alert, perfect math is a total myth. The reality is that all valuations are biased. It's just human nature. The only real questions are how much bias is hiding in the numbers and which direction is it leaning? Because, let's be honest, that bias usually leans heavily in the direction of whoever is paying for the valuation. We all have a natural tendency to find the exact numbers that support the story we already want to tell. But here is the really reassuring part, especially if complex math stresses you out. NYU professor Aswath Damodaran points out that simpler valuation models actually outperform the incredibly complex ones. Why? Because every single new input you add to a model is just a brand new opportunity to be completely wrong. There is no such thing as a perfectly precise valuation. In fact, the payoff to valuation is usually greatest when it's least precise. So you can officially ditch the 1,000-row spreadsheets. Precision is often just an illusion.
Moving right along to step 2, numbers versus narratives. This is the quant-qual convergence.
So we just busted the precision myth. Now let's put on our detective hats, because this is where the real investing magic happens. Think of your research like a boat in the water. Your quantitative data, things like returns, volatility, and Sharpe ratios, that's your heavy anchor. It's objective, fast, and shows exactly what happened. But the qualitative context, the team structure, their ESG principles, their core philosophy, that is the current. It's the subjective narrative that explains exactly why those numbers look the way they do, and whether that boat is actually built to survive a storm. Which brings us to step 3, decoding the annual report. Let's go interview the internal witnesses. If you've ever opened an annual report and immediately felt overwhelmed, here is your cheat code. Start with the financial highlights for a quick bird's eye view. Then skim the chairman's message to see how leadership is trying to spin the year. But step 3, the management discussion and analysis, or MD&A, this is the absolute gold mine. This is where management is legally forced to drop the marketing fluff and reveal vital context, looming industry threats, and their actual strategy. Only after that, you dive into the raw financial statements. And when you do hit those financials, there's one massive trap you absolutely have to avoid: confusing standalone with consolidated financials. Standalone represents only the parent company. Imagine a parent company that looks terrible on paper, but they own a subsidiary that's quietly raking in millions of dollars. If you only look at the standalone document, you're missing the entire party. Always look at the consolidated numbers, which combine the parent and all its subsidiaries to get the true, accurate picture of the whole business. All right, step 4,
Porter's 5 Forces. Time to step outside and evaluate the neighborhood.
Because let's face it, a company doesn't exist in a vacuum. Even the most brilliant management team is gonna drown if the environment is totally toxic. These 5 external pressures dictate a company's real competitive advantage. First, you've got rivalry among existing competitors. Second, the threat of new entrants, like could 2 kids in a garage easily disrupt this whole business? Third, the threat of substitutes. And finally, you analyze the bargaining power of both the buyers and the suppliers. For example, if a business relies on literally one single supplier for its core materials, that supplier holds all the leverage, and that is a major red flag for you as an investor.
When you map all those forces out, you're basically looking for the ultimate real estate checklist. An attractive industry means high barriers to entry, weak bargaining power from suppliers and buyers, very few substitutes, and a low level of fierce competition. Spotting a company in a neighborhood like this, that usually means they command real pricing power. And pricing power means higher profits, much better perception from Wall Street, and ultimately a higher share price for you.
Okay, we are in the home stretch. Step 5, the hybrid investing approach. Let's put this entire toolkit together.
Think back to that dot-com disaster we talked about at the very beginning of this explainer. A great spreadsheet is awesome. It's fast, it's scalable, it screens perfectly for baselines, but it means absolutely nothing without a solid underlying story to keep the ship anchored against the current. The story is what actually reveals the team's conviction, the cultural fit, and the real long-term potential of the business beyond whatever the temporary hype is today. You've got to constantly cross-check the numbers against the narrative.
So, as we wrap things up today, I want you to take a hard look at your own portfolio and ask yourself this final provocative question. Do your stocks have a good spreadsheet, a good story, or both? Because relying solely on the numbers might cause you to miss some massive red flags that only a human narrative can reveal. But relying only on a great story, well, that might just make you the bigger fool. Mastering this hybrid approach is absolutely the key to smarter, more resilient investing. Thanks so much for diving into this explainer with me, and happy investing.